Hello everyone, this week we are going to learn cost and the supply of goods. This is kind of a technical chapter, so please pay attention to the calculations that I will go over the slides in this recording. So first we talk about the organization of the business firm. And in a market economy, firm owners are residual claimants. What does that mean? That means after you expend all the costs associated with production, the remaining is yours. So any revenue after costs have been paid is actually belonging to the firm owner. This provides a strong incentive for owners to keep the cost of producing output low. So the idea is to maximize the take-home income. So therefore, how you can do it? You can do it by minimizing the costs, because when you minimize the costs, revenue minus cost, which is profit, is going to be higher. There are different types of production. Two principal methods of production are contracting and team production. Contracting means owners contract with individual workers who work independently. So let's say you want to fix something at your home, or you want to renovate the bathroom, then you contract with people. So you contract with the people or the firms. That's called contracting. The other way is team production. Workers are hired by a firm to work together under supervision. So this is common. I think you understand that there is a manager and people work under the manager as a team. With team production, owners must reduce the problem of shirking, employees working at least than the normal rate of productivity. So with team production, there is the problem of shirking. So what do we mean by shirking? Long coffee breaks. Owners will attempt to control shirking through both incentives and monitoring. So the owner or the manager could provide incentives for hard work or monitor the employees, but monitoring is costly as well. What is principal agent problem? This is the main problem because of the teamwork. The incentive problem that arises when the lack of information makes it difficult for the purchaser, which is the principal, to determine whether the seller agent is acting in the principal's best interest. So where do we see this principal agent problem? For example, you want to buy a used car. You don't know what the condition of the car. Seller has the private information, and the purchaser, you are the buyer, which is the principal, just trust what the seller says, right? So we just expect seller is acting in the principal's best interest. Firm owners face this problem when dealing with employees, because you cannot always observe or monitor the employees' actions. Employees could shirk, and you have the principal agent problem here. There are three types of business firms. The first one is proprietorship, which actually refers to the small businesses, most of the small businesses, and these are owned by a single individual, make up 72% of the firms, but only 4% of total business revenue. The second type is partnership. Partnership is very similar to proprietorship. The only difference is owned by two or more persons. 10% of the firms, total firms in the US, and 14% of business revenues. Cooperation is the third type, owned by stockholders. In contrast to unlimited liability of proprietorships and partnership, the owner's liability is limited to their explicit investment. So for corporations, the story is different, right? Because if you own a business, you are responsible for all actions you do for the business. You might manage it badly, or you might manage it very good and make lots of profit, and all liability is on the owner. But for corporations, there is a manager, but also there are stockholders or shareholders, and stockholders, shareholders are owning the corporation. And the stockholders' responsibility or liability is limited to their investment or to their shares. And 18% of the firms in the US are corporations, and 82% of business revenues come from corporations. So the advantage of corporations is that you are the shareholder. You are just have the stocks, and if the stock prices are increasing, you gain additional capital appreciation. But if the management is bad, you lose money because your stocks are going to lose value. So you're not responsible with anything else other than your investment. If the corporation goes bankrupt, you just lose the amount of shares that you have. The amount of money you lose is the amount of your shares. This is the advantage of being a shareholder in a corporation. But there is a disadvantage. Corporations are taxed more heavily than the sole proprietorship. Why? Because corporations pay tax, and also as a shareholder you pay, and in addition to that, an income tax. So from the profit, corporations pay a tax, and the net profit is distributed among the shareholders, and shareholders are actually paying an income tax. Since 1977, an increasing number of states allow a hybrid form of business organization called the limited liability company. So the LLC combines the limited liability advantages of a corporation with the tax advantages of a sole proprietorship and partnership. In proprietorship and partnership, you just pay the income tax from the profit. There's no double taxing. Next, we talk about how well does the corporate structure work. Actually, corporations are doing well. And the next question is, do corporations serve the interest of consumers? Factors that promote cost efficiency and customer service but limit shirking by corporate managers. In a market economy, firms must both compute for investment funds and serve consumers. The compensation of managers can and generally is structured in a manner that brings their interests into harmony with consumers and shareholder owners. So there are incentives built in the payment to the managers. Therefore, they usually act in the interest of the consumers and shareholder owners. And also, that's not the only end of the story. If managers didn't do well, there is the threat of corporate takeover. It's actually this threat of corporate takeover helps keep current managers from straying from a profit maximization. So the prevalence of the corporate form of business provides strong evidence it's an effective form of business organization in many sectors of the economy. Now, the next topic we need to talk about is the economic role of cost. So, when we talk about the economic role of cost, we shouldn't only consider the monetary payments that you have to make from your pocket in order to start a business. And don't forget, time is actually a resource, and it's a very valuable resource, and time is scarce. Therefore, if you use your precious time to start a business, there is an opportunity cost of this resource, which you could have used it for your second best alternative. Okay, so you need to think about the opportunity cost when we talk about economic role of cost. In economics, we have two types of costs, explicit and implicit. And the total cost, when we refer total cost of doing business, it's the sum of explicit and implicit costs. So what are explicit costs? These are visible costs. And these, when you make a monetary payment, then you have the explicit costs. Implicit costs are not actually very much visible to people. Implicit costs involve resources owned by the firm that do not involve a monetary payment. So what type of implicit costs we're talking about? First of all, you spend time, right? You spend time to run the business, time. As I said, it's a resource. And you could have used this time to work for a company as an accountant and can earn 50K. So this is a foregone wage and it's a resource. You don't see that payment from your pocket. That's why it's not an explicit cost, but it's an implicit cost. What other implicit costs of doing business we have? We have, let's say you have saving of 50K and you use this 50K for a business, right? So if you borrow this money from the bank, 50K, your accountant is going to say, okay, you have to pay interest, right? Let's say interest payments of 5% every year, which corresponds to 2,500. So this amount is going to be actually in the accounting cost because it's an explicit cost. You need to pay 2,500 annually because of borrowing 50K from the bank. But if you use your own resources, the interest, foregone interest earning, let's say 50K, the interest earning of 50K is again 5%, which is 2,500 you give up because you put this money into the business, is your implicit cost. So if you borrow money, it's an explicit cost, but if you use your own resources, it's an implicit cost, which is an foregone interest. Okay? So what is economic profit? Economic profit is total revenue, which is, let's write it here, total revenue minus total cost. But remember, total cost not only include explicit, but also implicit costs. Okay? Economic profit occurs only when the rate of return is above the normal market rate of return. And when we say, which we are going to talk about a lot in the following weeks, when we say firms earning zero economic profit, that means firms are earning a normal market rate of return. If, let's say, normal market rate of return is 10%, that means they are making this money annually. But they are not making any money above that. So that means this can cover their opportunity costs, right? Because if they don't invest in the firm, they could be able to earn this 10% by saving this money in a financial instrument. If they earn 10% in the business, they are making zero economic profit. Why? Because of the implicit cost of foregone interest. Okay? Accounting profit, on the other hand, is much easier because it's the total revenue minus the explicit cost. You don't need to think about implicit, what is the opportunity cost of using your resources. Explicit costs are monetary payments and they are visible. So why we don't include in accounting profit implicit cost? Because it's very subjective, right? That's why you just focus on the explicit cost. But because of the definition of accounting profit, most of the time accounting profit is generally greater than economic profit. So let's look at one example. To calculate accounting profit, we need to subtract only the explicit cost from total revenue. So let's look at here, total revenue is 170K, and you are going to subtract only monetary payments, grocery, utilities, taxes, advertising, labor. So total explicit cost is 100K, accounting profit is 70K. To calculate economic profit, subtract both the explicit and implicit costs from total revenue. So we have already subtracted the explicit costs. So we need to subtract additional costs like personal investment. You could have earned 7,000 with your personal investment in another investment instrument, in any other asset at the normal market rate return. So the foregone interest, because you give up. Why? Because you use the money in the business. Rent, let's say you use your own building, which could have been rented $18,000 a year. You give up that money too. This is an implicit cost. You're not paying it from your pocket, but since you use your own building, you give up the rental income. And also you could have find another job if you are not doing your own business, which let's say you could work as an accountant, and that is 50K too. So 7,000, 18,000, 50,000, another additional $75,000 you are giving up doing the business. And total explicit and implicit cost, 100 from explicit and then 75 from implicit. Look what happens. You're actually making a bad decision because you are losing 5,000. So economic profits are used in decision making. So what does that mean? That means if you just do your second best, you could have earned 75,000. Why? Because you could get 7,000 from your personal investment, 18,000 you rent the place, and 50,000 you work as an accountant. So you could make 75K. But by doing business, you are only making 70K. So actually you shouldn't do the business because your second best alternative is better. So economic profits are used in decision making. So you have questions here, you can think about them on your own. And now we move to another topic which is very important. Please understand the difference between short run and long run time periods because the costs and definitions are different in short run and long run. So the short run is a period of time is so short that the firm's level of plant and heavy equipment capital is fixed. Okay? In the short run, output can only be altered by changing the usage of variable resources such as labor and raw materials. Let's say you have a restaurant business and you lease the place for 12 months. So this is your short run. Why? Because In 12 months, you can't break the lease. If you break it, there will be consequences. And the only thing you can do is to increase revenue, is to increase your labor, right? Or the menu items, which are all variable. So if one of your resources fixed, then you are in the short run for that business. Okay. Let's look at long run. Long run is a period of time sufficient for the firm to alter all factors of production. In the long run, firms can freely enter and exit the industry. So in the long run, none of the resources are fixed. You can change everything. So if you think about the restaurant business, 13 months is actually a long run, because in 13 months, he could change the place that is leased for the business. So long run is combination of short run, and each short run there is one fixed resource. And the time duration of the short run and the long run will differ across the industries, okay? For instance, for a restaurant business, short run might be 12 months, but for an airline, since the planes are leased for 5 years, short run could be as long as 5 years. And next we talk about the categories of costs. The first one is the total fixed costs. And the cost that you see here, please pay attention, this is short run, okay? Why? Because we have one fixed resource, total fixed cost. Costs that remain unchanged in the short run when output is altered. So what does that mean? Let's think about a pizza restaurant. Okay, the oven you purchase for cooking pizza is actually a fixed cost. Why? Because you either produce 0 pizza that day, keep it close, or 100 pizzas, you have to pay for the oven, okay? So costs that remain unchanged in the short run when output is changed is called fixed costs. Most of the physical capital are considered as fixed costs. Factory is considered as a fixed cost. Insurance premiums, how many units of pizza you produce, you have to pay. Property taxes and the opportunity cost of fixed assets are all examples of total fixed costs. What is average fixed cost? Let's say for oven, you pay $100 to the bank because you buy it with the loan every month. And every month you produce 100 pizzas. So total fixed cost, let's say it's the only fixed cost for your business, is 100. What is the average fixed cost? Average fixed cost is $100 divided by 100 units of pizza. So you're asking to yourself, if I produce 100 pizzas, how much I pay in terms of fixed cost for one pizza, okay? Fixed cost divided by output is average fixed cost. And average fixed cost is declining over the units of output. Why? Because if you produce 200 pizza instead of 100, then the fixed cost turns out to be 0.5. So the cost is dispersed over the quantities you produce. Total variable cost, sum of costs that increase as output expense. For instance, again, pizza restaurant example, if you hire labor, 1 labor, 2 labors, and it's increasing, right? Because it increases since you need more labor to produce more output. Cost of raw labor and raw materials is another example. Raw materials, if you want to produce more pizza, you need to buy more ingredients. Average variable costs, it's the same idea like average fixed costs. You divide it, total variable cost, by the output. So what is total cost? Total cost is the sum of total fixed costs and total variable costs. Average total cost is total cost divided by output. So when we say average, you always divide by the number of output. Another important cost that you need to understand is marginal cost. Marginal cost is very important to make decision. Economics is decision-making science, so we need to make decisions at the margin. If that is the case, we need to understand what marginal cost means. It's the increase in total cost associated with 1 unit increase in production. So if you answer the question, okay, if I want to know how much I should spend to cook 1 more pizza, okay, then you are answering the question of what marginal cost is. So to cook one more pizza, you may need maybe more cheese, little bit more cheese, dough, and you see this is the marginal cost. And typically marginal cost will decline initially, reach a minimum, and then rise, and we explain why is the case. So let's look at the figures, graphs of short-run cost curves. Total fixed cost is you spend it, let's say you spend $100 and do not vary with the output, hence they are the same whether output is set to 100,000 units or 0. Average fixed cost, as we said, you pay lots of, let's say for 1 unit $100, you produce 1 pizza, it's 100, but then when the output increases, let's say quantity is 100, average fixed cost is $1. Why? Because average fixed cost is fixed cost divided by quantity. Marginal cost, as we said first, it decreases, it reaches to minimum, and then it increases. Average total cost follows a similar shape as marginal cost. It first decreases and then it increases. Now let's continue on this topic of output and cost in the short run. So as we said, ATC curve is U-shaped, right? It's first decreasing, average total cost, and then it increases. So at this stage, fixed cost, average fixed cost is high, right? Because you produce not as much as units. This is called underutilized. And average fixed cost is actually dominant in the calculation of ATC. Remember, ATC is the sum of AFC plus AVC. So this is high. Therefore, ATC at the beginning is high. But once you produce more and more output, AFC going down, and therefore ATC goes down. And ATC is high for an overutilized plant because MC is high. Okay, remember the MC producing additional unit of pizza first decreases and then increases. Let me explain the reason so understand the basic intuition behind it. So let's say you need one labor, right? One worker you hire, and then that worker produces 10 pizzas in an hour. And then you hire the second worker, but then second worker means now 2 workers are working here. Okay, 2 workers altogether increase the amount of pizza in an hour to 25. Okay, so the first worker changes the amount of pizza from 0 to 10. So additionally, the first worker produces 10, and the second worker, because 2 together produces 25, the first 10 comes from the first worker, additionally produces 15. So what is happening here? It's very simple, guys, okay? You are in the short run, you have fixed resources, and you can only change the variable resource here, which is labor. But when you add more labor, let's think about this first worker, has to do everything in the restaurant. Prepare the dough, put the things in it, put the pizza into the oven. But when the second worker is hired, they specialize, right? The first worker maybe does the preparing the dough part, and the second worker is responsible for cooking. So by specialization, production increases, right? So that means this producing an additional pizza here is much cheaper because you're producing more pizza by increasing the same number of workers. But this is not going to be the same. When you add the third worker, maybe you'll still see an increase in production, let's say 40 pizzas. So the third worker changes the production by, let's make this 50, 25. But then there's going to be a point that this is going to stop. Why? Because the fourth worker maybe, with the addition of the 4 total workers, total product, let's say, increases to 70. What happened here? Since you have fixed resources, you have 1 oven and 1 simple restaurant, 4 workers might make the place very crowded, right? So the productivity of additional workers may go down. So making pizza, additional pizza becomes more expensive at the later stages of the production. Therefore, MC is first decreasing and then it's increasing. Remember, MC is producing how much it costs to you to make additional pizza. So now we come to the law of diminishing returns. This is a very important concept and you need to understand it well to understand the cost curves in the short run. And law of diminishing returns is related to short run. As more units of a variable resource are applied to a fixed resource, output will eventually increase by a smaller and smaller amount. When a firm faces diminishing returns, marginal costs will rise with output. So let's look at these definitions first. Total product, total output of a good associated with different levels of a variable input. Marginal product, the change in total product due to a 1 unit increase in the variable input. Average product, total product divided by the number of units of the variable input. Let's look at this example. So what is total product? It's very simple. You have 2 workers here and they produce for a total of 20 pizzas. 4 workers, 46 pizzas. 6 workers, 64 pizzas. As you see what happens, first total product increases sharply, right? Specialization, remember. And then it increases but at a decreasing rate, okay? And then it reaches to a top point and then goes down. So why? Because this part is because of specialization and this part is because of fixed resources, and the production place becomes very crowded. The productivity goes down. Now we are going to calculate the marginal product and average product, okay, for this example. So what is marginal product? Is the change in total product divided by change in labor, okay? That delta sign means change. Change in total product from 0 to 20 units. Change in variable resource, in this case labor, from 0 to 2. So marginal product is 10. So each worker produces additionally 10 units. Okay. Now let's calculate the marginal product at 4 workers. Change in total product divided by change in labor. Total product increases from 20 to 40, 26 units. Divided by labor changes from 2 to 4, 2 units. So marginal product turns out to be 13. You see, additional worker has more productivity than the first 2 workers. Okay. How about average product? Average product is very simple. Okay, you take the total product 20, divide by the total number of labor. 20 divided by 2 is 10. The same for 46. 46 divided by 4. And 64 divided by 6. That's how you calculate average product. Let's look at this example. So this time the variable units increasing by 1, so we don't need to divide total product by the change in units of variable resource because it's always 1. You are increasing every time by 1 unit. So total product increases from 0 to 8. Marginal product of the first worker is 8. Total product increases from 8 to 20. Marginal product of the second worker, because the first 8 units are already made by the first worker, the additional unit is produced by the second worker is 12 units. For the third one, it's 14. Why? Because the first 2 workers together produce 20. With the addition of the third worker, production increases to 34. Therefore, it's 14. Here, the fourth worker is 12, right? 34 to 46. The 3 workers all together here produce 34 units, and by the addition of the fourth worker, the output increased to 46. So the change in total output because of the fourth worker is 12. And now here, as you see, productivity goes down from 5 to 6. Turns out to be 8. And here, it's going down more, 4. And here it's negative. Negative means that they are not producing. It means that the total product is decreasing when you add the 10th worker. So the marginal product is increasing first and then decreasing afterwards. And average product is total product divided by labor, 8 divided by 1, 8, 20 divided by 2, 10, and so on. Okay. So you can see here total product. When marginal product is increasing, total product is sharply increasing. When marginal product is actually start decreasing, we have a section of total product that the total product increasing but at a decreasing rate. That's why it's sloping less compared to the first part. And when the marginal product is negative, total product is actually decreasing. You are here. So this is 1, 1, and until here 2, this is 2, and here is the third part. So short run total cost curves. Now let's look at the total cost curves. Remember, total fixed cost is a straight line. Total cost curve is the sum of total variable and total fixed cost. Therefore, both are an increasing curves. Okay, they are increasing, but they are increasing sharply when we add more output to the production. So let's calculate the total cost, total fixed cost. 0 output, you have 50, and it's always 50. Plus 0, 50. And for the 2 units output per day, 50 plus 25, 75, and so on. So average fixed cost curve, remember, average fixed cost curve is fixed cost divided by quantity, 50 units divided by 150, then 50 units divided by 225, and when you produce more and more, you have AFC declining over the outputs. Average variable cost curve, first decreasing and then increasing. Why? It's because of diminishing marginal returns. Diminishing marginal returns of the resources. So workers are specialized, working more output, costs are dropping. Remember, worker is a variable cost. And then the place becomes crowded, so they're producing less output. Therefore, variable cost is increasing because you hire the same labor, you pay $10 an hour, but this labor produces 2 pizza, compared to here, when you pay the same labor $10, produces 5 pizza. So producing additional pizza is actually cost me $2, even the same for the variable cost, but here it costs me $5. And then here you can see the marginal cost. Now let's look at how we calculate marginal cost. Marginal cost is total cost, change in total cost divided by change in quantity. If your total cost increases from 50 to 65, when you produce 1 additional unit, then marginal cost is 15. Why? Change in total cost from 50 to 65, 65 minus 50. When you add 1 more unit, 15. Okay? For this one here, so 65 to 75, additionally, how much you spent to produce this unit? 10. 84 to 92, 8, and so on. So marginal cost curve is first decreasing and then increasing, as I explained before, because of diminishing marginal returns. Average total cost curve is ATC here. Looks like very similar to AVC, but it's above the AVC because you have to add the fixed cost, average fixed cost, to get ATC. It decreases first and then increases. And marginal cost curve always intersects at the minimum point of ATC. So MC always crosses ATC at its minimum point. Let's try to understand with this with a simple example. Let's say GPA is your average grade, right? Average grade. And then getting, for instance, A from this course is your marginal grade. Why? Because you are adding 1 more grade to your average grade. Okay? So let's say your average grade is 3.0, which is B. Getting A, that means a marginal grade higher than average grade. Your average grade increases, right? Yeah, if you get A, your average grade is going to be maybe 3.1. And now let's think about getting C. This time marginal grade is less than average grade, GPA, and therefore this is going to actually decrease your average grade. So the same idea here. If marginal cost is less than ATC, ATC is going down, and if marginal cost is higher than ATC, ATC is going up. So therefore MC intersects with its minimum point. So you can answer these questions on your own. And now we are going to talk about output and cost in the long run. The long run ATC shows the minimum average cost of producing at each output level when a firm is able to choose a plant size. So let's say you have this curve. Okay, quantity 1, this is plant size 1. And then you have this curve, and this is quantity 2. This is a bigger plant, okay? And now you have this curve and quantity 3. So if you are producing Q1, you are probably choosing plant size 1, right? Because this minimizes the cost. And if you're producing Q2, then it's better for you to choose plant size 2. And if it's Q3, you produce more output, then you should choose plant size 3. So when you combine the minimum points of all these short run ATC curves, you get the long run ATC curve. So you need to find the best short run for each output level and then draw the long run average total cost that passes through the minimum of short run average cost curves. Now the next important topic that you need to understand is economies of scale, but economies of scale is related to long run, okay? Diminishing returns is short run, fixed resources is short run. When we talk about economies of scale, everything is variable, there is no fixed resource. So economies of scale, you can see that in some of the plants when you produce more output, average total cost is going down, okay? It's not increasing back. It's going down. It's a long run. And this can occur for two reasons. Mass production. Mass production is more profitable because you don't need to spend lots of fixed resources at the beginning. You have the factory, you just need to produce a lot. And per unit cost producing is going to go down because your fixed resources, fixed costs are spread over the mass production. The second reason is specialization. So if actually you have a mass production, then each worker are going to specialize in one task. So they become professional, right? They find best ways to finish the job in a short period of time. But if it's a small production plant, then maybe a worker needs to do 3 or 4 tasks in a day. So it's hard for that person to specialize. Even training this person requires much more time, right? And also improvements in production as a result of experience. These workers going to get more experience, right, in the mass production plant by doing only one task. But 3 to 4 tasks, it may not be easy. So that's why we might have economies of scale. This economies of scale increases in per unit cost as output expands. The textbook gives the example of fine dining. So you need to change your menu all the time to attract the customers. But this requires a lot of coordination. So when the production place gets bigger and bigger, there might be issues with management, right? Because coordinating everybody, making decision might be harder. That's why we have this economies of scale. That means the average total cost in the long run increases when you increase the production in this unit. Constant returns to scale, unit costs are constant as output expands. So you can see different types of long run average total cost. You have economies of scale here because when you produce more and more, average total cost is decreasing. And then this is the ideal plant size. And when you increase the quantity, then you see the diseconomies of scale. And the long run average total cost here has a downward sloping segment, which represents the economies of scale, an upward sloping segment, which represents diseconomies of scale, and a flat segment, which represents constant returns to scale. So the flat region of the curve between Q1 and Q2 represents the constant returns to scale. Any of the plant sizes in this region would be ideal because they minimize per unit cost. And here we see the economies of scale for the entire range of output. This can happen. Let's think about utility companies, utility production. Like electricity production, you may need to spend maybe $1 or $10 million at the beginning. But then when you add an additional customer, it's not costing you at all because you spend a lot of money for infrastructure, for producing electricity, but then adding one additional customer is not going to cost you much, right? So that's why the cost is decreasing, total cost is decreasing as you service more homes. And the last two parts we are going to talk about very briefly. What factors cause cost curves to shift? So prices of resources, when prices of resources are higher, cost curves shift. Taxes, it becomes more expensive to produce when you have higher taxes. So again, cost curves are going to shift to the left. That means they are going to increase more. Costs are going to increase more. Regulations, costs are going to increase more. Technology, if it's a cost-saving technology, then it's going to reduce the cost curve. So higher resource prices and costs. If resource prices increase, the cost of production increases, and thus the ATC and MC shift upward. And the last part, the economic way of thinking about costs. Sunk costs are historical costs associated with past decisions that can't be changed. Sunk costs may provide information but are not relevant to current choices. Current choices should be made on current and expected future cost and benefit. So let's look at one example from your textbook. Let's say you spend 100K to get one machine, right? That machine cannot be used to produce anything else but just ice cream. And then that machine costs you $10,000 to maintenance over the year. And let's say that machine produces 50K worth of ice cream, but 46K you spent just to produce ice cream in terms of labor and other ingredients, right? So this machine is bringing 4K revenue, but it costs you 10K. So should you keep this machine? Because you think that you pay 100K. 100K is a sunk cost, is done, right? You can't recover this cost, but you can recover 10K. Since you are making negative 6K every year, you shouldn't use that machine, right? That's the idea of sunk costs. Sunk costs are not recoverable, so the only thing you can just look at is the future cost, which is the maintenance of machine 10K, and this machine produces 4K of ice cream, so maintenance is higher than the revenue it brings, therefore you should stop using this machine. And cost and supply, when making output decisions in the short run, it is the firm's marginal costs that are most important. Additional units will not be supplied if they don't generate additional revenues that are sufficient to cover their marginal costs. For long-run output decisions, it's the firm's average total costs that are most important. Firms will not continue to supply output in the long run if revenues are insufficient to cover their average total costs. And that's the end of the chapter 21. Thank you.